Every now and then, breaking news shakes the entire market. Your portfolio drops, headlines everywhere. Everyone's telling you what to do: buy gold, buy oil, sell tech. But does that actually make money? I built 2 AI-designed trading strategies and tested them against real geopolitical conflicts. At first, this looked exactly like the video I expected to make. It didn't end that way. Stay to the end, because the takeaway changed the whole episode. I told Claude I wanted to detect geopolitical stress from market signals, not predict events. Just read how markets react. I kept the instrument list simple. VIX as the crisis trigger. Gold and treasuries as safe havens. QQQ as the fear barometer. Energy and defense as the conflict plays. Then I asked for strategies that exploit how these instruments interact. Their cascade effect and their divergence. Strategy 1. Cascade momentum. When a crisis hits, VIX spikes first, then gold and treasuries catch a bid, then energy and defense follow. The later movers haven't priced it in yet, so we use VIX as the trigger and buy the laggers. Strategy 2. Divergence. During genuine geopolitical stress, these instruments should all move together. When one doesn't, that is a mispricing. We trade the outlier back toward the group. One rides the wave. The other trades the mistake. Claude generated the QuantConnect code for both strategies. I fed the first-round backtest result back to Claude. Claude suggested 6 modifications to test. Things like per-instrument sizing, convergence, take profit, and holding period limits. All toggleable so we can experiment. To compare all the configurations, I asked Claude to build an analysis tool. Runs in the browser. No install. Upload trade history and it breaks everything down by crisis period, by instrument, by strategy. We tested against 4 real conflicts. Each one is a different kind of shock, and that turns out to matter a lot. Crimea 2014, US-China trade war, Russia invading Ukraine, and the Middle East escalation from Hamas through Iran. Crimea. Both strategies barely moved. Our best configuration finished up about 1.4%. A slow annexation just doesn't create the sharp signals these strategies need. Trade war. This is where the 2 strategies split. Cascade gained about 8%. Divergence lost money. The slow grind of tariff escalation whipsawed every mean reversion signal, and energy was the drag. Russia-Ukraine. Divergence finally worked. The best version finished up just over 3%, while both Cascade versions lost money. This was the one crisis where the sharp shock really favored divergence. And the Middle East. Cascade's best showing. Up 21%. The chart actually trends upward. Multiple waves of escalation gave the strategy repeated signals, and defense stocks did most of the lifting. 21% sounds great, but then I had to ask the uncomfortable question. Was that edge, or was everything already going up? Let's break it down by instrument and have a closer look. Defense stocks were still the strongest overall performer. ITA drove the winning Cascade runs in Crimea, the trade war, and especially the Middle East. It was not the top contributor in every single case, but it showed up more consistently than anything else. Energy was messier than the headline trade suggests. Oil through USO only really worked in Russia-Ukraine and got hit in Crimea and the Middle East. Energy stocks through XLE were positive in some windows but got crushed in the trade war, so the simple bile-on war headline mostly failed. And the strategies actually complement each other. Cascade works during sustained multi-wave events like the trade war in Middle East, where instruments trend for weeks. Divergence works during sharp singular shocks like Russia-Ukraine, where instruments dislocate then snap back. Neither one wins everywhere, but together they covered every crisis we tested. So defense stocks were the real winner, which raised an obvious question. What if you just bought and held ITA? No signals, no timing, just hold. So I pulled out our buy and hold strategy from episode 1, which completely changed the whole episode. During Crimea, our best strategy made about 1.4%. Just holding ITA, it made about 4%. And the Middle East window was brutal. Our best strategy made 21%. ITA buy and hold returned 87%. I just froze for a second. Not because the strategy lost money, because it was riding the move, not beating it. So I checked the rest of the market. Crimea was short and messy. QQQ gained about 8%. SPY gained about 5%. Everything was drifting up together. Trade war. The SPY gained about 5%. QQQ was up more than 22%. Cascade gained 8%, which is competitive against the broad market, but still behind tech. Russia-Ukraine was the exception. QQQ fell about 12%. SPY fell about 9%. ITA roughly flat. Divergence strategy up about 3%, actually beat all of them. Middle East is the humbling one. SPY rose about 65%. ITA rose 87%. Our strategy's 21% wasn't hidden edge. It was a smaller slice of a giant bull move. That was the real pattern. The geopolitical events were short. The trends underneath them were much bigger. And active trading had one more problem. Every entry and exit paid spreads, slippage, and fees. Buy and hold paid that once. We paid it over and over. I started this episode because the Iran headlines made me want to do something. Trade it. Protect my portfolio. But here is the honest accounting. Russia-Ukraine was the only crisis where our strategy clearly beat buy and hold strategy. Most of the time, the market kept climbing through the crisis windows I tested. The real risk usually wasn't the crisis. It was overreacting to it. Next time a headline shakes your portfolio and your gut says, do something, maybe pull up the data first. That is what this series is about. Code and the analysis tool are on GitHub. Link in the description. Follow me on X at AI Quant Studio.